Trust preferred securities, or TruPS, were an esoteric way of raising capital for banks that gained prominence in the late 1990s. TruPS were counted as debt for tax and accounting purposes. At the same time, they were counted as Tier 1 capital for regulatory purposes. TruPS, therefore, allowed banks to raise equity capital in a tax-efficient manner, adding to their lure and popularity. On a bank's liability stack, TruPS sit right above its preferred equity. TruPS issuers are permitted to defer interest payments for up to 5 years without triggering an event of default, an important structural detail that we will focus on later. TruPS caught on in the banking industry because they were an advantageous way of raising capital. As TruPS gained popularity, Wall Street's financial engineering machine began pooling TruPS of multiple banks together and slicing them into different risk buckets or tranches. This gave birth to the TruPS CDO market in the year 2000. TruPS CDOs offered the benefit of diversity and allowed for efficient placement of risk, expanding the TruPS market's investor base. Issuing banks were able to bring down their cost of issuing TruPS, while investors from banks to hedge funds were able to invest in CDO tranches that best match their risk-reward mandates. Just like TruPS, this pooling and securitization also quickly caught on in the industry. From 2000 to 2006, the issuance of TruPS CDOs exploded and the size of deals increased. Deal structures became more complex, and competition between platforms led to looser underwriting standards. However, a benign economic backdrop kept deferrals and bank defaults in check. Banks were at the epicenter of the great financial crisis of 2008. The system-wide shock caused material impairments to banks' balance sheets. Bank regulators stepped in and required banks with low capital levels to stop paying interest on their TruPS, along with interest on preferred equity and dividends on common stock, in order to preserve capital. In the end, massive intervention by the U.S. government avoided a complete collapse of the financial system. However, bank failures persisted through 2013. During the crisis, as banks stopped making interest payments, structural features of both TruPS and TruPS CDOs were tested for the first time. TruPS indentures allowed the issuing banks to defer paying interest. However, unlike preferred equity or PREFs, indentures did not allow banks to stop accruing interest on TruPS. This back-due interest would have to be paid by the bank at a later date, as long as it did not fail. Deferrals caused CDO interest payments to be curtailed. Cash flows were also redirected away from junior tranches and towards senior tranches to allow them to de-lever and de-risk. Deferrals were perceived by the market as a precursor to large-scale bank defaults. Murky collateral disclosures further contributed to the uncertainty in the TruPS CDO market, causing tranches to trade down dramatically. Hildene saw this as a tremendous investment opportunity. In the early years following the crisis, opaque collateral disclosures prevented investors from knowing the banks behind a CDO's collateral. This severely hampered their ability to underwrite deals and invest in the market. Hildene started doing a deep dive and performed its due diligence to unveil the bank credits behind different TruPS CDO pools. Hildene also created proprietary analytics to rate banks and their TruPS based on various risk attributes. This allowed Hildene to not only understand exactly which segments of the collateral were in danger of default, but also which CDO tranches were most undervalued. In the years following the crisis, Hildene was able to take favorable positions in the TruPS CDO market, generating outsized returns for its investors. Since the end of the great financial crisis, TruPS CDOs have staged a remarkable recovery. Learning from their past mistakes, the U.S. government took various steps to bolster bank capital and curtail their ability to take inordinate risk. Chief among these steps was the Dodd-Frank Act of 2010. Regulators like the Federal Reserve, the FDIC, and the OCC have also become significantly more proactive, requiring banks to make new and more detailed disclosures, like submitting stress testing results. As a result, banks are much safer credits than they were before the financial crisis. As troubled assets went down and capital levels improved, deferring banks were able to come current on their TruPS. In certain cases, significant back due payments caused windfall gains for some TruPS CDO tranches. Over time, TruPS CDO collateral pools have continued to get cleaner. Today, bank failures are largely negligible. Of the 366 banks that have failed since 2010, 145 had TruPS exposure. Hildene correctly identified 133 of these 145 as having a high probability of failure. Over the last few years, the TruPS CDO market has outperformed investor expectations.